Dr. Raef, then we will start. Good evening to everyone. Let me welcome our keynote speaker today, Dr. Raef Lawson. We are indeed happy, Dr. Raef, that you are here with us today. I think this is the second time that you have joined us. Then we also have our council members. We have Mr. Manil Jayasinghe. Then we also have Mr. Jayasekara. We have Mr. Vijay Pereira. Then we have Mr. Gajendra. Then also we have our CEO and members of CMA. Ladies and gentlemen, let me welcome you to this seminar that we are having on profitability analytics. Now, this will be delivered by our keynote speaker, Dr. Raef Lawson. This has been a paper that has been prepared by Dr. Raef also, I think, jointly with Larry White, and that appeared in the Strategic Finance maybe some time back. And I saw it and I invited Dr. Raef to maybe to come and speak to us on this topic. Dr. Raef Lawson has also recently of course, he's been a member of our institute. He's a fellow of CMA Sri Lanka, which we are very proud that he's there. And recently, he's joined our academic advisory board, where he is a member. So we are very happy, Dr. Raef, to welcome you. And he was formerly the professor in residence and vice president of research and policy at the Institute of Management Accountants of USA. And currently he is the executive director, Profitability Analytics Center of Excellence. So we are very happy. I think the topic that you are talking is of profitability analytics, and you are the executive director of the Profitability Analytics Center of Excellence. So I'm sure we have got the right person to address us today. So with those introductory remarks, I warmly welcome Dr. Raef Lawson to deliver his address on this topic of profitability analytics. Over to you, Raef.
Okay, well, thank you for having me here today. It's a pleasure to be back. I think this is the third time that I've spoken to this group, so it's always a pleasure. And your organization does great work, and I'm glad to be affiliated with it. And it's a pleasure to be here today to talk about profitability analytics. I see from our backdrop that the emphasis is on value creation 2021. And that's really what profitability analytics strives to enable management accountants to achieve. And I'll talk about this more shortly, but the role of management accountants is changing. We need to become value creators, strategic business partners within our organizations. And we think this profitability analytics framework that I'll discuss today is a way to do that. So this is my little bio here, but again, I was previously with IMA for 15 or 16 years. Where I was vice president of research and policy and professor in residence. I've held positions in a diverse settings. I've seen every aspect of our profession, I think. And again, as you just noted, I'm the executive director of the Profitability Analytics Center of Excellence. And I just want to spend a moment talking about what that is. It did begin with that article in Strategic Finance where we initially laid out our profitability analytics framework. We now are an independent, non-profit professional organization called Profitability Analytics Center of Excellence. And we're dedicated to helping companies strategically manage their revenue, costs, and investments using analytical models to help their organizations make better, more informed decisions and create value. So again, that's going back to the emphasis of your organization. And as you mentioned, Larry White's very involved in this. Gary Kokins, who I know is a frequent presenter, is involved. Doug Hicks, Monty Swain, and a whole host of other people. So if anyone on this webinar wants to learn more about us, we have a website, profitability-analytics.org, and also a LinkedIn page that I'd like to encourage others on this call to check out and follow. But as the Profitability Analytics Center of Excellence, we are really engaged in advancing our profession and developing thought leadership in our in this area. And PACE and its directors, we've published numerous works by IMA to help organizations better manage their revenues and adopt better managerial costing practices. So these are just a sampling of what we've published, but I think that fourth item here is what you were referring to earlier. Again, is our first thinking on this area, and it's evolved somewhat since then. So why do we even need to think about profitability analytics or our value creation? It's in terms of background, we as management accountants have really not been doing a good job adding value to our organizations. And that sounds kind of harsh, but it's the reality we need to face up to. There's surveys that the IMA has done, one in 2003 that we conducted with Ernst & Young, that found that 80% of financial executives believe their costing information is inaccurate, but less than 20% want to plan to do anything about it. We've updated that survey at IMA in 2012. The results were even worse than the 2003 survey. And it's clear that a vast majority of organizations are using costing practices that were developed 50 or 100 years ago, and they have no plans to change those costing practices, even though the economics underlying organizations today has changed. And this lack of information that's decision useful affects how decision makers view management accounts. We've again done numerous surveys, and I think those in your audience who are in practice would agree with the idea that decision makers see management accounts as aid accounts, as assistants, basically. They're not actively participating in the development and execution of their strategy. It doesn't mean that we're not valued, but we're just looked at as skilled members of the staff who answer questions, perform required tasks, and provide required information, often for just external reporting purposes. As management accountants, we're often asked to justify senior management's decisions that are based on emotion and intuition. We're often asked to provide information that justifies decisions after they've been made. And that's certainly not the role that we want to have. So decision makers have fairly low expectations of management accountants, and we need to change that. And then one final proof point here. There's a survey by EPM Channel on how decision makers view accountants. And 3 of the questions from that survey are here. And what's listed in blue are the response from the finance respondents. And in red are the non-finance respondents. And the first question here is, how often is finance called upon to provide support when executives are facing important business decisions? And finance, about a third of them felt they were called upon to provide support. Obviously 2/3 did not agree with that statement, which is pretty discouraging. And for the non-finance respondents, the result was even less. When asked about with the right type of training, expertise, and tools, what's the level of support do you think finance can deliver to your organization? And there were a variety of responses that were available. The highest was game changer, and close to half of the finance respondents thought they could adopt that kind of role, whereas less than a quarter of non-finance respondents agreed with that statement, but they could be game changers. And then finally, what's the actual level of decision support that finance provides to your organization today? And getting a variety of responses. Game changer was the highest level, and only 7% of finance respondents agreed with that choice, and none of the non-finance respondents did so. So it's clear that finance is not viewed as being engaged in the decision-making within an organization. And even the response of finance professionals is rather low. But this is really not an acceptable situation. So we're living in an era of tremendous change, and we're fools if we think management accounting doesn't have to change as well. Technology is going to eliminate much of what we do, especially the part of our work that's rules-based, that's repetitive, that's highly structured. Technology will create new jobs, but eliminate many others. And those new jobs require new skills, require innovation, and experimentation. Roles in financial accounting, like stewardship activities that we perform, will largely be eliminated due to automation. Tax and audit, a similar situation exists. Again, automation will create new jobs, but they're not going to be the ones that we're familiar with today. So we need to be, in order to remain relevant, we need to be viewed as strategic business partners. We need to shift from an emphasis on financial reporting and stewardship, our traditional role, again, to becoming a business partner and strategic enabler. And by doing so, we'll enable our organizations to perform better. So in order to be perceived as a business partner and a strategic enabler, we have to do a few things. We need to earn our place at the table. In order to do this, we need to be able to deliver strategic insights. We as management accountants need to have a deep understanding of the business in which we're engaged. Combine that with our knowledge of accounting and finance to deliver insights that aren't obvious to our peers. We need to proactively look for ways to provide insight and not just wait to be asked. One of the best things that we can do to gain credibility in our organizations is to provide a little bit more insight than we're asked for, and that'll grow our credibility. We need to be able to better communicate financial information. how we word our choices, the choices that we have, and structure them can make a big difference. A common complaint from operational manager is that we provide information that is not understandable and meaningless for decision making. And we need to do the things that are here. We need to possess an understanding of the latest technology, have a good relationship with IT to ensure that we have technology that supports our transition to the role of business partner. We need to be able to think strategically. Again, if we want to be a strategic business partner, we need to be able to think outside the box. We need to build cross-functional relationships, develop thinking skills, the soft skills rather, such as better communication skills as we work with a broader team. And we need to, as companies, to invest in talent and have a commitment to foster current talent to reduce what is an emerging skills gap. So we've developed profitability analytics to provide a roadmap to management accountants to emerge as business partners. It helps define, the goal is to define and promote an internal customer view for management accountants. So much of what we do now is externally focused. And we need to not abandon that, but really think about what do our internal customers want and need. A big focus is to define areas of engagement. What do our customers need? Where can we add value within our organization? We need to define better internal decision support information. Where is data analytics information needed? What is the information? And finally, most importantly, we want to broaden and deepen management accounts engagement in the business and the strategic management process. So the profitability analytics framework focuses on internal decision support. Okay, it was developed to provide this high-level framework that management accountants can use to provide decision makers with both comprehensive and accurate internal decision support information. It's organized to focus on the key factors that influence financial success and the major tasks of executive management. So this means focusing on things like customers, internal processes, markets, data, investments, and all the things that we need to consider as organizations create value. And finally, I want to emphasize that this profitability analytics framework is not designed to be a method. It's not a step-by-step methodology that you can use. It's a framework which various methods can be used to incorporate portions of its structure. So its goal is to guide accountants in creating internal decision support information. Again, that will enable better internal decisions and create value. So profitability analytics framework encompasses traditional accounting tasks, such as financial reporting, record keeping, cash management. But again, it focuses attention on both financial and non-financial analytics using causality-based models. And I'll emphasize that much more later on, that we're using these causality-based models that can help provide management with realistic forward-looking scenarios analyses. It requires that an organization develop these robust models of its markets, customers, and business environment, as well as its internal resources, operations, and processes. And by developing these models, an organization will understand how it generates revenue, how it can manage its costs, how it can invest capital effectively, and therefore create value. So profitability analytics, we like to view as the point where revenue management, investment management, and managerial costing intersect. And what's notable about this is, if we think of our traditional remit as management accountants, where we traditionally focus on managerial costing, on cost management, and we think of that as our area of, definitely our area of expertise, but our area of responsibility. Investment management, we also have a role in, but we traditionally have not considered revenue management as an important area of responsibility, and it really needs to be. So profitability analytics looks at all three of these bodies of knowledge that we need to be conversant with. So the profitability analytics framework incorporates the traditional elements of return on investment, and how do we, in a simple way at least, compute return on investment? Well, it's profit divided by investment, or we can look at it as revenues minus costs divided by investment. And related to that are the three bodies of knowledge that I just mentioned: revenue management, managerial costing, and investment management. So it incorporates these three bodies of knowledge, but not necessarily in the traditional way. And this framework also includes an emphasis on organizational strategic management or strategic planning, because that's a critical engagement point across the organization. It's part of what the emerging role of management accountants need to be, part of being that strategic business partner that's the role that we really need to evolve to as management accountants. And again, why is that? We had talked about the traditional accounting work diminishing as technology evolves, as the routine repetitive tasks that we now perform disappear. And this framework seeks to set a new approach for management accounting, where we engage across the organization, creating actionable information and insights, again, for long-term value creation within our organizations. So at a high level, this is the profitability analytics framework. And it can be visualized as a 3x3 matrix, where the columns are the three stages of strategic management, and the rows are the three factors that go into the computation of ROI. Again, it's revenue, costs, and investment. And as we move from left to right, we start with strategy formulation. It's this first stage in strategic management. It encompasses the organization's plans for addressing its market strategy there, its plans for mobilizing its operations or operational strategy, and the resources needed to meet those expected demand, its investment strategy. And when you're formulating your strategy, you need to take all three of these into account. The second stage is strategy validation. An organization comes up with a strategy, and it has to see whether it can actually be done, what the results might be. And we do that with, as I mentioned before, using causality-based models that quantify the expected impact of the strategy, first in terms of operational non-financial terms, and then those are monetized so we can get the revenues, cost, and investment implications of the strategy. So again, we need to develop causal models to look at the impact of the proposed strategy. And then finally, in the third stage, we use our models to execute the strategy. We use it to forecast results, to make projections, determine what the impacts of various decisions would be on our financials. We can use it to support the various decisions such as pricing, process improvements, and so on. So at a high level, this is the profitability analytics framework. So we may go, oh my goodness, what is this? We're now going to decompose this high-level framework and look at its components. And we'll go through each of these slides in detail. And I'm showing you this just to get an idea of the overall detailed framework. But I want to emphasize again that this profitability analytics framework is not a step-by-step process. It represents a guide how to think about strategic engagement by management accountants to ensure that what we produce is high quality internal decision support information that can be used throughout the organization. And in that vein, I want to emphasize that we're not talking about just the C-suite, information for the C-suite. It's really from the C-suite down through the shop floor into direct customer contact points. And we want to get everyone in the organization rowing in the same direction at the same time. So let's talk a little bit about that first step in the strategic management process, which is strategy formulation. In strategy formulation, we think about using internal and external data, right, as a guide to formulating our market, operational, and investment strategies. The market strategy describes the current and expected conditions in the market and our plans to exploit those opportunities and create value. The results of the market strategy provide input into the operational strategy. The operational strategy describes the resources and capabilities that are available to our organization and how they're aligned and executed in order to meet demands of the market strategy. And then finally, our investment strategy for long-term value creation may be the most important part of our strategy, and it'll likely define how far in the future market operational strategies have to look. Of course, that'll depend on the nature of our business. So, and when we talk about investment, it includes both intangible and intangible assets. So the investments might be personnel, R&D, and other resources as well. So this, as I mentioned before, the focus of the profitability analytics framework is on points of engagement for the management accountant. We want to not just check and review information, but we want to proactively create and engage in each of these three blocks. We want to find insights and nurture innovation. So this will lead to a clear understanding of the opportunities available to the organization and perhaps the risks as well in the strategy. So with regard to the market strategy, as management accountants, we might ask, where are the company's profit zones? We're uniquely qualified to answer that question and provide that information to the organization's management. We can help gather intelligence on both internal and external to the organization. We can assess outcomes from past market strategies and feed that information back to marketing managers to come up with enhanced or better business strategies. We can help build build better business cases for various marketing strategies. With regard to operations, it's not just about producing products or delivering services, but how can support activities better add value to the organization. Investments, we mentioned that we're not looking just at the tangible assets, but intangibles as well. Are we investing enough in intangible assets, such as R&D, sales and marketing, HR, process improvement? And again, we need to differentiate between business sustaining investments and business growing to make sure we have the resources, both tangible and intangible, to grow our business as needed. So I wanted to say a word about strategic engagement and talk about participation versus judging. As a profession, accountants have a focus on independence and objectivity, and that's great, and that's definitely important. But as business partners, we need to be not just judging. We need to be participating. We need to be part of the team. And judging, no matter what we call it, whether it's evaluating or reviewing, is not participating. So this approach is particularly true, for example, with regard to a company's budget projections, revenues projections. We often feel obligated to challenge those, even though we haven't participated in their formulation. So again, we need to be part of the team that comes up with those projections and not just be critiquing us. So let's move on to the next step in the strategic management process, which is strategy validation. And what we want to do is validate the organization's strategy, first of all, from an operational, non-monetary perspective. So the key to doing this is to create effective models. And a model is just a simplification of complex realities that humans create so we can function in a world where these complex realities exist. Often reality is more complex than we can comprehend, but we still need to function in the world where this complexity exists, and we can do that by creating these models. And we do that, we build these models by selecting the factors that we think are the key elements in that reality. And we try to figure out what the relationship is between those elements. How does a change in one of those elements affect another? So what is a key concept here is this idea of causality, having a cause and effect relationship. It's a key to measuring the relationships. It's a key to the models that we build. It's critical that the models reflect causal relationships. It's what makes the models a parallel to what's happening in the real world. And often organizations base their models on correlation. Correlation has no role in model building. With correlation, there's no meaningful cause and effect relationship, no chain of events that you can follow. And causality is really the key concept that we need to follow in building these causal models. So when we're constructing these market operational investment models, causality is key. So let's look at these three models listed here. The market model describes the organization's structure and processes used to achieve its market penetration and achieve revenue goals. It includes key revenue factors like pricing tactics, capacity management, price sensitivity, and so on, marketing campaigns. Capacity management is especially key for companies that have a strictly limited perishable inventory, like the airlines, which have a limited number of seats that expire as soon as the plane takes off, or the whole hotel industry, whose rooms expire as the day elapses. And again, there are a variety of factors that you need to be able to model with a cause and effect relationship. We then get to the operational model. That's the one we're most used to as management accountants. It lays out the structure and processes that we're going to be used to meet our anticipated demand, to achieve the operational excellence that we strive for. And again, it's important to be able to develop a cause and effect relationship to take the market penetration from the market model and see how we translate that into understanding of whether we have the capacity within our operational model. And then finally, we need to be able to take into account the investment model, because the investment model will tell us whether we have the capacity to handle expected level of operations, whether we need to create new physical capacity, whether we need to create new intangible tangible assets to execute the strategy. Have we developed our employees enough to execute the strategy? Have we done enough R&D? Is our marketing plan sufficient? It's surprising when we've looked at implementation of the Profitability Analytics framework, how often a company's plan that's being evaluated using these causal models needs to be evaluated. Their strategy needs to be reevaluated. And it's because they often have a disconnect between the strategy and their proposed plan to carry that out. There's no operational models that they've developed using these cause and effect relationships. So again, this framework helps raise possible points of engagement for management accountants looking to serve as strategic business partners. Again, we can help assess the impact on unit volume from these various revenue drivers, revenue factors. We can help ascertain whether there are sufficient resources to reach the projected levels of sales, of market penetration. We can help identify the drivers of activities that will help generate the desired revenues. In terms of operations, we can help develop an understanding of what levels of activities are required to meet the demands of the market model. And again, in regard to investment, do we have existing sufficient resources? Are some resources underutilized? Can they be redeployed or sold? And what additional resources are needed? So again, as management accountants, there are many ways that we can be engaged in the strategic management process, and that should be our goal. Just a little note about the growing importance of operational models. Operational models are really growing in importance. In many cases, they're growing in terms of technology and sophistication faster than the financial models that finance and accounting traditionally employ. So in Industry 4.0, in all industries, it's all about automating, digitization, visualization, and connectivity of primary operational information. So, for example, in manufacturing industries, an operational model of the factory often includes operational and production controls. It'll include inbound and outbound logistics, and it's increasingly known and functions as a digital twin to the organization's processes and plan. So in other words, it's a complete operating and control system. So if we in finance can't figure out a way to support monetary metrics in these real-time operating models, we will not be engaged, and we will become increasingly irrelevant. So what difference can monetary considerations make? A colleague of mine tells the following a story about a South African mining company that put in place an operational control system, and the goals in it were expressed in terms of operational metrics. And the shift supervisors were challenged to come as close as possible to the operating envelope, and the various shift supervisors developed strategies to do so. But those strategies were quite different that they developed. And what was missing? It was the cost factor. With the cost factor, by looking at cost factors, they could determine which of the supervisor strategies were most profitable. And without it, they were clueless. So the company implemented an enhanced costing system. It showed in real time how close supervisors were to managing the various production factors in the most economical way. And by doing so, the company achieved optimal operating costs. So that brings us to the next step in the model. And again, we, up to now in terms of strategy validation, have been looking at models based on non-monetary operational information. As we just saw in that vignette, costing information, monetary information is also critical. And so when we talk about strategy validation, it's really a two-step process. First is building your operational models, and then monetizing the information in that, and by developing monetary models. So those models are first built using the operational quantities. Then we're applying monetary units in a way that will support decision making. So the revenue models should incorporate revenue pricing and demand assumptions from our strategic analysis and planning. The cost model monetizes the cost of the resources and processes that are in the operational model, and that can be used for decision making and operational optimization. It's important to note that the cost model and the operational model should reflect the entire organization and not just fixate on product and service costs. And finally, the investment model at this stage, we get to monetization as three distinct components. There's focus on acquisition, first of all. How do we acquire and create new capabilities with the resources that we have available? There's capital preservation, which looks at how we're going to ensure that the capabilities that we're consuming are maintained into the future. And again, that applies to both tangible and intangible assets. And finally, the cost of capital, how we ensure that our long-term investments are yielding a return that exceeds our cost of capital. One thing to note in all of these monetized models is that our monetization of processes and resources should reflect forward-looking economic costs and should not be limited to costs as measured by external financial reporting requirements. Using costing principles that are based on economics is essential to building a model that effectively represents actual resource use and their cost to the organization. So I think we're all probably familiar with examples of decision-making with regard to utilization of equipment, where we have a choice between using an older piece of equipment that's fully depreciated, but less effective than a newer piece of equipment that is still being depreciated. And if we're basing our decisions based on external financial reporting information from the general ledger, the manager might be tempted to say, let's go with the older piece of equipment because there'll be no depreciation cost versus the newer piece of equipment, although it might make more economic sense to use that more effective, more efficient, newer piece of equipment. So again, we need to base our models on economic costs, and not those necessarily contained in our general ledger that are used for external reporting purposes. So moving on to strategy execution, we're now armed with valid revenue, cost, and investment information. Management has the tools to produce realistic forecasts, and has decision support information that can be used to effectively manage the organization. So for revenue management, the model, and I'll just move on to here. For revenue management, the models can support decision about product configuration and pricing, duration controls, resource capacity, demand management for customers and channels. Can give us information on where our profit zones are, how to focus our marketing efforts. In the operations management model, it can help support process improvements, understand how our process improves costs, how to make improvements, how our process can be adapted to meet the changing demand, and so on. The resource and investment management model will support not only our capital equipment decisions, but decisions regarding investments in tangible assets. And as we see here, again, there are numerous areas for engagement for management accounts where we can help decision-making, provide information, and support the decision-making process in the areas of pricing, product mix, level of promotions, effectiveness of promotions. We can help cost reduction efforts, process improvement efforts, help them look at quality improvement efforts and assess those, as well as timely delivery efforts. And again, we can help support the various investment decisions. And the final step in the strategic management process is strategy evaluation. By having a causal-based model, we've identified the steps we need to get from here to there, and we'll compare what we've actually achieved to our plan. We have a way to evaluate any variance between the two. And so by having this loop back mechanism, the strategy evaluation, we can learn how to improve our models and adjust going forward more effectively. Having a profitability analytics perspective can help management accountants enhance their strategic engagement. On our PACE website, we have numerous case studies of how management accountants use this profitability analytics framework to serve as business partners and create value within their organizations. I have a bunch of examples here. I see I'm running a little short on time, so let's mention a couple of them. There was a forging company that had traditionally used a percentage of, had a focus on profitability as a percentage of sales. It was not as profitable as it desired to be. It switched to a focus on profitability as a percentage of value added using this causal model. And because it found out that this profitability as percentage of value added tracked more closely with the return on investment. use that as a gauge to develop a better pricing policy, and it increased its return on investment by 10 percentage points over a 4-year period. There was a company that priced its products at twice its material costs, believing that would lead to profitability. A new CFO came in to develop a causal pricing model, and the company, well, why was the new CFO brought in? Because the company became bankrupt. The new CFO developed a model based on causality, and the company returned to profitability again. The CFO unfortunately changed his mind about this new pricing model, went back to the 2 times material cost pricing model, and the company actually went bankrupt again and was liquidated. So again, there are numerous other examples on our website, and I encourage you to peruse those. So in summary, how does Profitability Analytics differ from traditional FP&A? Traditional FP&A is financially focused. Profitability focuses on operations, markets, and investments. Traditional FP&A is based on general ledger information. Well, we've seen that that information can lead to ineffective decision making. Profitability analytics is based on causal data that reflects resources, processes, and markets. FP&A, traditional FP&A uses traditional cost accounting, while profitability analytics employs managerial costing concepts. Traditional FP&A focuses on specific decisions, while profitability analytics is focusing on generating information for supporting decisions throughout the organization. And finally, traditional FP&A focuses on financial statements, while profitability analytics is a framework that focuses on economic reality. So you might say, well, how can I make profitability analytics work within my organization? The first step is in solving a problem is to recognize that it exists. We need to recognize that there's a need for a decision support model other than the one we're using for external financial reporting. These external financial reporting requirements and standards are not designed to support internal decision making and for making sound business decisions. FP&A, or financial accounting rather, we have to get out there. We have to be engaged throughout the organization. We need to understand the problems, concerns, goals of others in the organization. We have to have the knowledge to develop models that reflect the organization. They can't be so complex that no one understands them, but not so easy that people see right through them. And we can't judge and evaluate. I mentioned this before. We need to participate. Otherwise, we'll just become increasingly obsolete and irrelevant. The things that we've done in the past are being automated. We need to get out there and become valued business partners. So just a quick cartoon that summarizes this. You know, we've many companies as accountants, we're used to just our simple external financial reporting models. They're simple but wrong. The framework that I've gone to may seem a little complex, but it's the path we need to go down to provide relevant decision support information. So our Profitability Analytics Center of Excellence has a website I mentioned before. It's at profitabilityanalytics-analytics.org. We have the case studies I referred to, research monographs, a member forum, interest groups that we're forming, a members exchange. If you want more information, you can go there. We also have a page on LinkedIn, English and Spanish. I'm guessing the Spanish might not be of such interest, but I'd encourage you all to follow our page where we're posting, again, thought leadership information. And with that, I'll wrap up my presentation and invite any questions you might have.
Thank you very much, Dr. Raef. Can we now, if you can go out of the share screen, then we can start our discussion and questions. Okay. Thank you very much. I think, Dr. Raef, it was a very, very excellent presentation. And although I did not mention at the beginning, you really told the importance of a management accountant. Now we are a CMA as the Certified Management Accounting and the accountants and the National Professional Management Accounting Body in Sri Lanka. We are incorporated by an act of parliament. I think what you said is really something that as would definitely maybe help us and also give a better meaning to the management accountant. And what you really went into detail of the various areas, and of course one of the more important areas on the costing area, the model based on causality. I think that's something that we need to all keep in mind, because that would really be something that we are currently engaged in on the Cost and Management Accounting Standards Board, which we are doing. So we greatly appreciate what you have said. We have our expert panel, of course, in addition to the questions that can come up. So I'm just trying to, maybe I will ask few of them to maybe come up with their questions. I think we have Dr. Nuwan Gunratna. Dr. Nuwan Gunratna is one of our own members and a senior lecturer at the University of Sri Javardhanapura. Dr. Nuwan, you have any comments or questions to Dr. Raef?
Yes, thank you, Professor Vatawala. Now, I think as Raef explained, I think this framework provides an overarching framework to conceptualize the different activities of management accountants and how they can fit into the organizational profitability and in the long run organizational sustainability. Now, just to bring some perspectives from the Sri Lankan management accounting arena. Now, as you rightly mentioned, the use of management accounting tools and techniques in the Sri Lankan management accounting context is very low. The research, the studies, and even our own practical experience show that the use of management accounting tools are really at a limited level. So I think this is common in Sri Lanka as well as in this region. And when you look at these limited uses, and as you correctly mentioned, these users are focused mainly on the control and the stewardship functions. Especially, still the management accountants are using, heavily budgeting, standard costing, and variance analysis, and so forth. And their use of the new management accounting techniques or the modern management accounting techniques is low. Then that's one side. And then again, when we dig down to what are the reasons. So one major reason is the lack of management awareness and the importance of these tools. So I think there are many reasons for this, but one of the root causes is that the management accounting education, maybe when I say management accounting education, that includes professional accounting education as well as academic education as well. So when you present this framework, what I learned, what came into my mind as an educator is that, if we can show this framework, if we can use this framework to articulate where the different techniques are fitted in, I think it will provide the students or the future management accountants a broader picture. Because even today, through my past experience, what I realize is that most of the time, the students or even sometimes the management accounting lecturers, they think that management accounting simply as a calculative practice. So they think that we need to have calculators, when you come to a classroom of management accounting. So I think that mindset had to change. And maybe my question is, how do we really change the mindset of maybe management accounting educators as well as management accounting students to understand their broader involvement or engagement in strategy of formulation to strategy execution? Thank you.
Let me just respond to that, and so much of what you just said resonates with me, and I mean, we don't feel too badly about the low utilization of newer management accounting techniques in Sri Lanka, because it's a global issue. I mean, even in the United States, where one might think we use advanced techniques, it's not the case. And if you do a survey of U.S. organizations, I would say 80 to 90% use standard costing. I mean, it's almost embarrassing, but it's a lack of awareness, and this is the exact problem and exact issue why we form PACE, because as management accountants, we're stuck in this mindset from the 1950s, and we really need to evolve the profession. I mean, there's some sense of urgency here with the way technology is evolving, and we can have such a bright future if we do make this transition to strategic business partner. So we're the whole purpose of forming PACE was to build a community of folks, of companies, organizations that will advocate for this changing role of the management accountant, will help promote the use of better techniques and so on. And so we, in terms more specifically of your last question, in terms of academia, and it's very sad, because I was chair of an accounting department for my prior work life, and was a professor in residence at IMA for 15 years. So I was very involved with the academic community as well. And I've talked to the authors of leading management accounting textbooks, and so many of those textbooks are just a compendium of costing techniques and really don't emphasize this changing role of the management accountant. And these authors will say, I would love to get rid of some of this less relevant costing, less useful costing information, but the faculty will drop my book if I do. So I mean, we really need to get this information out to faculty as well. And that was your question. And so one of our members of one of the directors of PACE is Monty Swain. He's a professor at Brigham Young University, and he's reached out to the American Accounting Association, which is the Accounting Professors Association in the United States. And in November, he's going to be giving a webinar, American Accounting Association webinar on the Profitability Analytics framework. So we're reaching out to every segment of our profession, trying to raise awareness. We're reaching out to consultants, software vendors, and academics, practitioners, just trying to build this community of around the need for management accounts to be strategic business partners and provide better decision support information.
Thank you. Thank you, Raef. I think, Ruchira, you like to read out the questions that are there?
Professor, there's a question. Thank you, Professor. First of all, Raef, there's a question which has come from the audience. Actually, this question I also wanted to ask from you. Now, the model that you have mentioned here, which is about maximizing profits, or to focus mainly on the profit, to what extent we can apply this model for non-profit organizations?
Great. Well, thank you to whoever asked that question, because call it profitability analytics, but it's applicable is greater than just profit. And so it's applicable. It can be used by nonprofit organizations, and it can also be used by for-profit organizations that are interested in attaining not only profitability but environmental and social goals as well. So it can definitely easily be expanded or implemented by a nonprofit organization. And it was just a question of what would we call it, and it's like goal analytics didn't quite ring as nicely as profitability analytics. But it's as a nonprofit organization, you have your mission, your goals. You are formulating a strategy, and how are you going to achieve that strategy? You need to have develop a model, causal model that relates that considers the market in which you operate, considers your resources, your processes, and how you need to develop your organization to achieve your goals. So it's not necessarily just about costs, right? Because you, as a nonprofit, you may want to increase your membership, right? That's the revenue model there, based on the market model. You're going to need to develop resources to achieve those goals. So, and then even as a nonprofit, you probably want to break even. So I mean, you have to consider investments and costs as well. But it's just easily as relevant to nonprofits or governmental entities or any other type of organization.
Right. Thanks, Doctor. Now, this is another question, Doctor. To be useful, tell me what should be the qualities that we must look at in financial information?
The qualities.
Yeah.
Well, it's the primary criteria is that it's decision useful. So and that is situational specific, right? So it depends on the the context. So what the important thing to recognize is that we're trying to develop a model that reflects the operational reality of the organization. So it reflects cause and effect relationships. It's built on economic data, not necessarily just data from the general ledger for external financial purposes. So we can, based on the decision we want to make, we have a framework, right, that we can use that helps make that decision. So if it's, should we accept an order, right? The traditional one shot deal type of order. We need to understand what's the impact on our costs, on our and that will affect the machine utilization. That is dependent on capacity of our operations, of our processes. So, the one thing that I want to emphasize is we don't want to just have a financial model. And, in many cases, traditionally, when we do FP&A, we build these financial models that don't have a grounding in the operation of the organization, and then we wonder why the results that we achieve are different than what we had projected. So it's so perhaps to answer the question a little differently, we definitely need financial information, but it needs to be grounded in this non-financial operational understanding of our organization.
Thank you. Mr. Jayasekara, you have any comments? I think or questions?
Nothing special. Now, as Professor said, now in the teaching process, especially, can we apply these concepts straight away?
Can this framework be applied straight away? Absolutely. That's the short answer. You know, it is a holistic framework, and what I would suggest perhaps is to ask the organization or look at an organization and see where its pain points are, where its greatest challenges are. So it might be in the revenue management portion. I mean, it's there's a lot going on here, and depending on the resources that you have available, and you might want to think of where should you focus your efforts first. You know, just in traditional change management, 101, you might want to build a simple model for part of this framework and get early successes that will then get organizational buy-in and help you then develop additional models, perhaps more detailed models. But yeah, absolutely. It's holistic framework that can be. And again, it's not a detailed methodology, but we've developed some case studies on implementation of parts of it. Traditionally, you might want to start with a project in the costing area, cost management or management costing area, because that's something that we are most familiar with. But then once that's completed, you could say, well, let's look at revenue management, because we don't want to just minimize costs. We wanted to take into consideration the impact of our actions on revenues, and we could conceivably, if you just look at the cost side, be taking actions that negatively impact revenue and profits. So again, it's hopefully something that we need to look at holistically eventually to create long-term value for our organizations. But I did want to mention, I see one question here, and getting back to the first question, we designed this to be methodology neutral. And there are a lot of people that are very adamant about one technique versus another. I mean, activity-based costing, which I support, but there's also resource consumption accounting and various techniques. And I think every technique has its use, its applicability in a certain circumstance. But we should really say what's the issue. Let's build a model, and then let's apply the techniques, the managerial costing techniques that are most applicable here. And that could be theory of constraints. It could be anything, balanced scorecard or whatever. So it's not saying let's use this technique or that technique. We want to be this holistic framework that practitioners or organizations can use the most applicable technique to the issue they're facing.
Thank you.
Thank you, Dr. Raef. Mr. Karnaratna, you have any comments or questions?
No, Professor, I don't have anything in particular,
Okay,
and that
right.
was a very good presentation. Thank you.
Okay, Mr. Gajendra, anything that you have?
Yeah, thank you for CM arranging a very well presentation. One question on non-profit organization, Professor, whether we can use the same thing to the state-owned enterprises. The theory into practice, how it's easy to implement in SOEs. Thank you.
So this framework is looking at how management accountants can provide strategic insights inside their organizations, and decision useful information. And it's not context dependent. So management accountants work in very diverse organizations. They work obviously in corporate or private accounting. They work in nonprofit organizations. They work in government. And each of those organizations should have a mission, right? And it might be to make money, but it might be to feed people. It might be to heal people. And each of those needs to develop a strategy around how they're going to accomplish that mission, and how it's going to implement that strategy and execute it. So to your question, if this framework is as applicable to governmental entities, SOEs, and nonprofits as it is to private organizations.
Thank you, Dr.
And some might argue that the governmental entities might need it more than the private organizations, but we won't go there.
Thank you very much. Mr. Narangoda, do you have any questions or clarifications that you want to ask?
Thank you very much, but it's no questions, Professor. It's a very impressive presentation. When I listen to this, is a more towards the focus in the self-regulatory concept of the organization, especially. So it's more similar to, since I was having some previous regulatory experience, is more towards its very off-site supervision regulatory method within the organization. It's very impressive if we all, especially mercantile and industry practice, can enforce these things, and you can achieve ultimate result. It's a very impressive presentation. I think Sri Lankan context, all industrialists should listen and practice this. That's what I believe. Thank you, Dr. Lawson.
Well, thank you for that compliment. We're very excited about it. We think it is applicable to many different types of organizations. I used to see a question here. I just want to answer where you can get more information and what kind of books or whatever. I would suggest a good place to start is our website, and I just want not to promote it, but we do have monographs there, or links to monographs on Profitability Analytics. And then we also have monograph on managerial costing. We've developed a conceptual framework for managerial costing that talks more about causality. We have a monograph on revenue management fundamentals, which again is that third body of knowledge that we need to be increasingly familiar with. And we're actually developing one on investment management. So we have various case studies. So if you want more information, that might be a good place to start.
Dr. F, one question is on the mindset. One thing is how it could be applicable to the maybe the senior management, so that their mindset could be either changed or maybe brought in line with the concepts that you mentioned. How do you think that this mindset could be really brought into the organization improvement purposes?
Yeah, that's a great question. I know a few years ago I'd done a survey of the role of management accounting in this region, and there, a lot of organizations run by promoters that really didn't view the accountants and management accountants as having a significant role in decision making, but that's a generic problem in many organizations. And the short answer is we have to earn the right to sit at the table. So we need to develop proof points. We need to show how we can add value to the organization. And as we do that, we will build credibility throughout the organization. We need to again adopt a mindset that we're enabling others in the organization to fulfill their roles, to achieve their goals. We need to reach out to others and, the marketing manager, the production manager, and so on, supply chain manager. It's, what information do you need? What are your challenges? How can we work together to achieve those goals? We can't just be the critiquer of others' performance. And that's unfortunately the historical role that we've assumed. It has to change, and it has to start with us. But again, there's, as I showed in this presentation, there's just numerous ways that we can engaging as business partners, as providing information that will help our organizations succeed. And I would say perhaps, look for the low hanging fruit, where might be an easy, a way you can do that easily, quickly, and show results. And then, others will start seeing the value that the management accounting function can contribute to the organization. And over time, trust will be earned, credibility will be gained, and, folks will start coming to you for your advice. We do have a reputation of being independent, of being, impartial, and but having, accounting and finance skills, and then if we view as being strategic, having a strategic oversight as well, that will be something that will be valued within our organizations.
Thank you very much, Dr. Raef. I think we are very thankful to you for sparing your valuable time with us, and always you have been kindly accepting our invitation. So let me thank you, and may I now invite Mr. Ruchira Perera to give the vote of thanks. Ruchira, can you?
Yes, thank you, Professor. Good evening, of course, to you. Good morning, Doctor. Thank you very much once again for accepting our invitation and for coming and delivering an excellent presentation to us. It was very interesting, Dr. Lawson, and it was very informative, not only for the people who are here, but also we'll be sharing this presentation later. So I think for all who are here, this presentation is very useful, and also thank you very much for delivering this presentation. You mentioned this is the third webinar with CMA, and I hope you will continue to support us in conducting webinars in the future as well. So in my vote of thanks, let me once again thank you for coming here today. And also I must congratulate Professor Vatawala for conducting these webinars continuously for the benefit of our members through the CPD programs. Thank you very much, Professor. For our moderator, Dr. Nuwan Gururatna, Senior Lecturer of the Department of Accounting of University of Sri Jawaharlal, my fellow council members, members of CMA, and all other participants. There were participants from various other professional institutions. So I thank them all for their patience, and thank you very much once again for being here with us and for listening to this excellent presentation. Thank you.
Thank you very much, Ruchira. So once again, let me thank you for your kind presence, because profitability is a very, very popular term. Everyone is looking for profit. But today, profitability analytics, I think, will really give them the method by which they can really earn this profit. Because it's, as you say, it's not only the revenue, but also the cost that has to be looked into. And reduction of cost is only not enough, but maybe increasing the revenue is also something, especially in this environment, everyone is affected. And profit is something that everyone is looking at, and we have found that many companies are doing well. Some of them are also facing a lot of difficulties, and I'm sure what you mentioned to the importance of the management accounting provision will enable us. And since you are also now closely involved with us in our accounting, the advisory board on which will really help us in the syllabus, and also the cost and management accounting standards board, which will help us to take the management accounting forward. So once again, let me thank you and all our council members, Dr. Nuwan, and all our participants who have definitely have gained quite a lot, and we look forward to supporting them in the future with our CPD programs. Thank you and all the very best, and good night.
Thank you,
Pleasure
James.
being
Thank you,
here.
Dr.
Thanks
Lawson.
for having me.
Thank you, Dr. Lawson.
Thanks.
Thank you,
Thanks,
Dr. Nuwan. Thank you.
Doctor.
Thank you, Professor.
Okay. Thank you, Mr.
My
Kamaran.
pleasure. Thank you for having me.
Thank
Thank
you.
you.
Thank you, Mr. Kamaran.
So,
Thank you, sir.
thanks, sir. Thank you. So
Bye-bye.
see you. Okay.
Sounds good.
Okay. We'll keep in touch, because I think
Yeah,
a
thank
lot
you.
of
Thank you very
things.
much.
Good.
Right. Okay.
Bye.
Thanks, Jay.
Thank you.
Okay. Thanks.
Thank you,
Okay.
Professor.
Bye. Thank you. Bye.